figure we got a lot of stuff to talk about that will be
Definitely.
easy. You know,
Well, I mean,
so
I think a tried and true for sure would be, I mean, almost every time we get on here, it's what's the state of the market? I mean, that's the easy one for sure.
yeah. What are you seeing on your end as far as not just your clients, but you know, your peers and people you work with and stuff like
Well,
that?
it's an interesting, man, because it's feast or famine. You know,
Yeah,
the people that I rolled into the business with, so the people that are 4 years and under,
yeah,
some people are just not around anymore.
yeah. Those
And
are the ones struggling the most, seems like, right?
dude, that's the toughest one. And then there's that group who, like yourself, man, has been in it longer, has had the clientele and the referrals that
Yeah,
they're able to stay afloat. But I mean, if you just look at the numbers itself, you see the total sales and new listings are just down.
yeah, yeah.
I mean, year after year.
Record lows from like
Yeah.
2008 and stuff like that as far as the amount of transactions being done. But you're right. It's like those top 10% of realtors are just still killing it, or at least seemingly so. You know,
Yeah.
from the outside perspective, they're still busy at the very least doing transactions.
Well, it was, this is perfect. It's humbling because I door knock, right?
Hmm.
And on one of the days that I was door knocking, one of our top producing agents was door knocking.
Really? In the
I
same
went
neighborhood?
the same exact street. I did one street. I turned the corner and I was like, "Dang, dude! Someone's beating me to the doors. They're probably handing out like religious flyers, which I always end up coming across."
Uh,
No, no, sir. It was one of the top agents that was door knocking, and I was like, if that doesn't tell you right there about the market, I mean, what does?
do you know them, or did you have a conversation with them, or?
I submitted an offer on one of their properties and I didn't get it accepted, so I was a little butthurt. But
Yeah, you stay on your side of the street. I'll stay on mine.
well, but isn't that so weird? Because I did a piece of her street,
Uh-huh.
and somebody had I guess just got done speaking with her. So he's
Okay.
like, "Oh, you're one of your other Keller Williams people just came to speak with us. Like, what's going on?" I'm like,
Oh,
so I had to skip that street and go to a different one.
and what did you tell? Well, how did your conversation go with that homeowner?
I mean, he was a little short, but I said, no, we're in the same office, but we're here for different reasons. I'm giving you an
Yeah.
update on the market. I think she was handing out a different flyer.
Yeah.
So,
Nice.
you got to be quick with it on those doors, baby.
So clearly, to stay a top producer, you got to do top producer stuff, which is door knock, get out there, meet people, shake hands, and you know, make some
Yeah,
friends.
that was the humbling part, man. So I go, shoot, if they're doing it and that speaks to it being a rough market, then I almost have to increase, my production level
Yeah.
and keep busting it because it's a fun one. It's
Yeah.
definitely
Yeah.
a fun one.
Yes. I feel like I've definitely seen similar things on my end. Like the people that have been in the industry for a long time, you get calls, and like me myself, I've been doing this and going on 13 years. So
Dang, man.
between mortgages and the real estate. So I've been lucky to stay busy in that sense, whether it's doing a mortgage for someone or doing a real estate transaction for somebody. But I feel like the people that are actually buying, it's either you have a need where you have to move, or
Yeah.
there's a large life transition going on, whether you're about to have a kid and you live in a one bedroom or something along those lines that's making you make a move right away without waiting, because the
Yeah.
people that want to buy seems to be the case that they're waiting for whether the rate to come down or more options to be available on the market, just because the amount of listings are also at an all-time low, along with the amount of transactions.
Oh, dude.
Um, but
And it's
yeah,
it's interesting because it's we're transitioning from a low inventory, ultra competitive market, right? We were we were having 15, 16 offers on one house, right?
Wow, insane.
And it's transitioned out of that, obviously in part because of, the higher interest rates, whatever it might be. But now it's not even a competitive market, and it's still, it's low inventory, not competitive market. And the clients that I've closed most recently have been a 1031 exchange, so basically an investor,
Yeah.
and 2 cash buyers,
Yeah.
which, that's crazy, or a dual income.
Yeah.
And those are the types of buyers that I'm seeing right now in the market.
Yeah. And did you notice those cash buyers? Are they buying at retail price, or are they getting a good deal on a property that's been there for a while?
Because what I told them right out of the gate was everybody's looking for a deal, especially if you're going all in on a cash offer, especially here in SoCal.
Yeah.
I told them let's look a little bit higher than in your price point and see what we can negotiate. Or the other one was what's been sitting for a month plus, and see if we can work our way, down that way. And that's what happened to work for us. Hey, we get closing costs, we get repairs, and we get some off the price, but it is having to be a little more strategic.
Yeah.
Especially if you're an all cash buyer.
Yeah, and I feel like if it's like the same situation as a normal market, if the property is good to go and turnkey for the most part, it's still going to have a lot of competition. But if it needs a little bit of work, you can get a decent deal. If it's been on the market for a while, you can probably be the only offer on the table and maybe work out a good situation in a credit from the seller for the closing costs or for repairs or things like that. Like I just had a client buy a property in Riverside. And granted, it was a client that this is probably my 4th transaction with them. They were originally a loan client of mine at Wells Fargo. I think they were one of my first loan clients ever back in 2011. And he has a very common name. I won't say his name for privacy, but a very common Hispanic name. And he's had a lot of trouble with credit fraud throughout the years. Like people, somehow somebody else's account shows up under his credit because his name is so common, or they're purposely, it seems to be the case that this last time around, they're purposely, because I helped him get this account, a Citibank credit card, off his credit prior to us starting to look, because his credit had gone down. And overnight it went down about 125 points from being like a 750, 760. He's in the mid 600s. So his wife reached out to me, and we definitely did some work to get that account taken off. But yeah, they bought a fixer in Riverside for $440, almost unheard of to find a house under $500. But it definitely needed some work. It was a long time rental for the sellers that were selling it, and they hadn't done much in, I don't know, a long time. Maybe I don't know how long they owned it for, but it needed pretty much everything. They were coming in with a heavy down payment and had some funds for closing after post closing that they'll be able to use for the repairs. So for them it works out, but not everybody's in that situation where you could put down. I think they put down 40% because it was 440. They had about a couple hundred down, and then also had some money to fix it up afterwards. So not everybody's in that situation, especially if you're a first-time home buyer. Granted, they're older. This is not their first home that they buy. So they were able to take advantage and get a good deal in a great neighborhood. But like you mentioned, it's not a common scenario right now with the way the rates are and stuff like that.
No. And I mean, thankfully that they were willing to go. Were they already in Riverside, or
it was one of those situations where not only do they have a good amount of reserves, but they also needed to make a change. Okay. So they were married but living apart in different states due to family reasons, health reasons, and that kind of stuff. So the husband was they used to live together here in Bellflower. The wife moved to Las Vegas a couple years ago to live in their condo that they owned out there in Las Vegas, because she has some family out there as well. But he had to stay here in California and work. So as a married older couple, they were doing like the long distance thing, and I think it was just, it was time for them to kind of get back to living together. So they were looking for a property where she could move back to Riverside. They had some reserves from the home that they sold a little while ago, and are also planning on selling their condo in Las Vegas after we close on this property. So it was a little tricky to get the loan done because their margins were very slim in the sense of a debt to income ratio for the qualification of the mortgage, but ultimately we got it done. Signed loan docs on Thursday, so hopefully we'll be funding Monday or Tuesday and recording Monday or Tuesday. So happy for them.
Yeah, no, dude, that's awesome. How much do like other mortgages? Because I'm assuming if they had additional properties, they had other mortgages. How much does that play into their debt to income?
It plays a big part. They actually didn't have a mortgage on this one. It was paid in full because they bought it for a pretty good price, about $75,000. They bought this condo for a long time ago, so it was paid off. They used it as a second home for a while, and so here's like a little, a learning experience for me as a mortgage broker where. If you have a departing residence that you live in now and you're going to go buy another property, most lenders will let you use the rent, the expected rent from the departing residence, right? But because it was a second home, they couldn't use the expected rent. If it was a rental, they would have let them use it, or if it was a primary residence. Now, they were both on title, but only the husband who lived in California was on the mortgage. And on the new mortgage, only the husband was going to be on the new mortgage. The wife could not be on it. And because of that, they viewed it as a second home, and they wouldn't give them rental income for it. So it was a very slim DTI, debt to income ratio, but ultimately we got it done. As a mortgage broker, I have access to a few different lenders, and some are a little more strict than others. So I had to dig deep for this one prior to us even looking, just because we knew, under 440, there's not a lot of options, even in the Inland Empire, in a respectable neighborhood per se. And so we knew it was going to be an issue.
There's not that many options either.
Yeah.
I mean, even in Lancaster, like, you could touch the 400s pretty easy.
Yeah. So we knew it was going to be an issue. Not that when they first started looking, we didn't know exactly where they were going to land, but we wanted to get them to qualify for as much as possible. And actually, from when they started looking to when they bought, the rate went from 7% to 8%. So it changed what they qualified for. It's like they qualified for here, and it kept going down every week that the rate went up. And now rates have eased up a little bit here the last couple of weeks, but they were looking pretty much at the peak of the high rates here within the last year. So it didn't help their situation, but we were able to get it done, find the right lender for them, and hopefully we'll be heading over keys here on Monday or Tuesday. So, but with doing this whole search for them and things like that, I've been seeing a lot of, or at least I've been digging into like who's buying, who's not.
Yeah.
And a lot of it seems to be, investors are buying right now, cash buyers, or I also see like wholesalers finding properties off market and then, either double closing or assigning it over to some kind of investor or cash buyer that they have on their list that they already know will close fast and are looking for discounted properties. And then these investors are fix and flipping, because those properties that are more turnkey are definitely still selling a little bit faster, especially if it's ready to go. Because I feel like most people that are buying, they're not in construction, or they're not, handyman or savvy with that, and they want to, even if they have to put a little bit of work into the property, they want something that's livable that they can live in and don't have to make an immediate change. And they'll be like, okay, we can move into this property and then fix these little things, like maybe change the windows or something within the next year or two. But if it's something that needs extensive work, where it's like carpet from the 80s, popcorn ceiling, needs a new roof, needs, every fence is falling apart, those are the ones that especially a first-time home buyer is not really as willing to take on that bigger project.
For sure.
And that I feel like that's where I see the investors and the wholesalers taking those properties into contract, and then finding somebody that's willing to put in the work and then put it back on the market as more of a turnkey or closer to turnkey.
Yeah,
for those
too.
retail buyers, for those retail.
Well, I'm sure you've seen it with your first time home buyers when they tell you up front, oh, a fixer upper sounds great, and you take them to that first fixer upper, and they're like, oh wait,
it's not as good as I thought it was.
I don't think I want any part of that right now.
And there's levels of fixer uppers too. There's like a light fixer, and then you see some that it's like this person has lived there for 30 years and hasn't done
one thing.
Yeah, exactly. And those are tough to move into and live at that property and get it done. I mean, I've experienced recently with my parents. They bought their home in 1996, and when they moved in, they did a few things to it. Just they had young kids, and I was in 5th grade at the time, and they haven't done anything to it since. And then about a year and a half ago, decided they wanted to redo their kitchen and redo, take down a wall here or there just to make it a little bit more of an open floor plan. And they lived in a construction zone for about a year. It wasn't easy, and they didn't think it was going to take that long. But once you start getting through the permit process, or you have issues with contractors, things get delayed, and you have to live in that while that's being done. And if you don't have a kitchen, then you gotta, you gotta work around that, which is not easy.
No,
you can't cook or store anything, and your house is dust. Like their home is not that big. It's about 900 square feet, and there's 5 people living in it, and they didn't have a kitchen for about 6 months. So, it's not easy.
A lot of barbecuing right there.
Yeah. Well, the thing was too is they're redoing the garage also. So they took all their storage out of the garage, put it in the backyard. So it's like nothing. Backyard's full. Interior of the home's being redone. And it was a lot of work. So that's why people want to take on those projects.
Oh, dude, 100%. And when I do get people that are looking to buy right now, I mean, I cannot say it enough when they're like, hey, I'm 5-6 months or even a year out from buying a home. I tell them you have to think like an investor. I understand, the timing is never going to be perfect. Yeah. And who knows what could happen a year out. But at the very least, if you speak to a lender up front, if you get pre-approved up front and really think like an investor, somewhere in that year's time, a property is going to come up, a deal that you want, and that's the best time. And that's why investors are out hunting right now, because they go, hey, interest rates are high, competition is low, people aren't out there, I'm going to find something.
Yep.
And that's how you have to think.
100%. And I mean, is it ever the perfect time? Even if it is, you're not thinking that it's the perfect time, because obviously the perfect time was 10 years ago. Yeah. And, I wasn't thinking it was the perfect time. So even if it is the perfect time, you'll never know 100%. You will never be 100% sure that this is the perfect time. Even as an experienced investor buying an investment property, they're going to run their numbers and cross their T's and dot their I's as far as what they're aware of and what their knowledge base is of what is considered a good investment deal for them. But even they know there's a risk to it, and that there could be issues that arise as it goes. So that's just kind of the thing, is you got to take the leap of faith. If you can afford the payment and you have a need for a property, jump on it. I feel like right now we're seeing the typical annual thing that the amount of transactions or the amount of people buying is slowing down, right?
Without a
There's
doubt.
more. You see that there's more listings available, and that there's some price reductions going into effect that are normally not the case, especially through the strong buying months. So right now is the best time to buy a house. And if you're looking at 2023, when was the best time to buy a house? It's in November or December. And I know it's like, hey, you're a realtor. It's always the best time to buy a house. But it's almost like deja vu. Last year, rates were considered to be high. Everybody's like, it's November, December. It's super slow. This is the beginning of the crash. And I actually had some clients looking, during December. Their search spilt into early 2023, and they ended up closing escrow in late January. But then as soon as March hit, all of a sudden it's like crazy competition. And while they were looking, they were lucky. A lot of times they were bidding, there was only maybe one or two other offers, and they ended up getting a great deal in Culver City, Mar Vista area, I guess right next door to Culver City.
Yeah.
And then we saw what happened March, April, May, June, July. Is like all these properties, being bid up, especially in strong neighborhoods. You and I are in Southern California, so there's a lot of people here and not a lot of room for new construction or development. So if you're looking here, you have limited options. I saw in the Inland Empire a little bit more options, a little bit softer markets, especially like Indio, Palm Springs area, because I did have some listings out there. But that's more of a second home market and more rural. So that, those were staying on the market a little bit longer, even if they were turnkey. Like the one I had in Indio, it took about 45 days to sell, which is still not bad, a month and a half for an investment property. And the people that were buying it were also buying it as an investment property. They were 1031 exchanging. They were selling a property they had in Texas, and they were buying this one with the funds from the property in Texas. So, yeah.
Yeah,
But,
that's it is what it is, man. And like you said, it's the slowdown is happening. I think we're at 30 days on the market right now.
yeah.
Where if you're looking in July, we were 12 days on market. If you put something up in a week, it was gone.
Yeah.
Now we're at about a month. It's that slowdown, and it's funny because last week I was talking with a couple of my wife's coworkers, and it's still the same line as I heard 4 or 5 years ago is still out there, waiting for the market to crash.
Yeah. I mean, I've heard that line since I started real estate, I think. It hasn't crashed at least since I've been in it, because I got into real estate right after the last crash. Started doing loans 2010, 2011, which was when people were refinancing their mortgages that they got in 2005, 2006, 2007. And the rates that they were refinancing at the time were very similar to now. It was like 7.5%, 7%, 6.75. And then the rate dropped to about, I would think I was refinancing people into 4.5s right around there from like 2011 to 2013, 2014. So they were getting a significant drop in their mortgage payment. The values weren't quite there yet. So some of them were underwater, but they were taking advantage of this program. At least if they were in a Fannie Mae or Freddie Mac loan, they were doing this program called HARP, where they could refinance even if they were underwater or they didn't have necessarily the equity to refinance without getting mortgage insurance added onto their payment, which, nobody wants to do that, is refinance and add mortgage insurance to your payment. So, there's going to be a point in time when those rates do come back around. Will they go as low as they were in, 2020, 2021? That's to be determined. Probably not, just because those were the lowest rates we've ever seen in the mortgage industry. But they'll take a dip. If you locked in at a 7.5, and it drops to a 6%, and you have $1 million mortgage in LA, you're going to be saving a significant amount of your monthly payment to make it worth it for you to refinance. So, and coupled with the low transactions and the slower market is obviously what we've been seeing with the whole antitrust lawsuit going on and things like that. With the verdict being in favor of the plaintiffs, in Missouri at least. Now, granted, NAR has talked about that they're going to, keep this going, push it up to the Supreme Court, and all that stuff. So I think as far as it reaching our market in California, it might be a little while till that happens. But I feel like regardless of where the verdicts end up, if it does go up to the Supreme Court and things like that, there will be a little bit of a shift in the industry as far as the commission structure for buyer's agent or just general realtor commission structure. So to be determined how that will be, but we're also in a market that's ever changing. Real estate is ever changing. Financial services is ever changing. So you can't stop change. We'll just have to adjust and see how that plays out. But I feel like if you talk about a common narrative, which is affordable housing or making homes affordable for first-time home buyers, if buyers have to pay for realtor commissions out of pocket, it's going to make it less affordable as a first-time home buyer to buy that first house.
Yep.
Or if you have to go to the listing agent to have them represent you on the seller, it makes it a little tougher to know that they're have your best interest at heart before the seller's best interest, because they obviously you have a fiduciary duty, and some listing agents are even not open to representing both because they know it's difficult. Because if that buyer cancels the transaction for whatever reason, the inspection or anything like that, they're still going to have that seller as their client, because most of the time you enter into a contract with them to sell their home for 6 months or a year or whatever that time frame might be. So yeah, it's going to be tough, especially if you're a new buyer and you don't know as much about real estate or as much about how the transaction works, because even on our end, we see a lot of unexpected things. Every
deal, there's something new.
Every deal is unique. And us that we've been in the industry for years see new things all the time. So it's very hard as a first-time home buyer to be in the know that you're making the right decision. You already have a lot of doubts as it is. So it's always good to have that one source of knowledge that you can trust is telling you the right things. So we'll see. It's going to be an interesting waters to navigate here in the next year or two. But there's not much that we can do to control that. So we just got to keep moving forward and do the best that we can for our clients.
I mean, we're a service-based industry.
Yeah.
And first-time home buyers, like you said, they're already under so much stress, not only financially, but the prospect of moving sucks, which buyers agents act as their agent, their confidant, their friend, their connection to all these things.
Yeah.
It's so interesting to think that the structure will change so much, and it could potentially put the buyers in a harmful position.
Yep.
That's the interesting part. But as long as we provide great service, and we have both had referral business, meaning we do our job and do it well. I mean, we will be here to continue to help the home buyers. Now, the pay structure is going to be very interesting.
Yeah, it'll be new uncharted waters, but it is what it is at this point. And I guess once those changes come to California, which as of right now there isn't anything I see, at least locally, that we see adjusting on that. We have seen some stuff in New York and obviously Missouri, and I think now in Illinois, where there's some new lawsuits that are popping up as well. But who knows? That lawsuit's on the other end. It's the buyers, so we'll see. Yeah, I haven't read too far into that. Trying to obviously stay busy and make sure that we finish the year strong. But it'll be interesting to see how that plays out and how we're going to approach it on our end. So it is what it is. But what I have been seeing is a lot of investor transactions. That's why I have this hat here. Burr, I actually went to a meetup last week, and I was a lucky raffle winner. Actually, and it was interesting because so they had 4 hats. They were raffling at the end, and this is the one I wanted. And so all the other 3 hats, someone else won. And then I'm like, ooh, I'm thinking in my head, right? Like, oh, the only hat that I want is the one that's actually still left. And boom, what do you know? I got the hat. It was
Yeah.
meant to be. Left there extra positive. And the meetup was with this real estate investor who he does fix and flips. He also buys and holds, and he's also a real estate agent as well. So Burr, if for anybody that is not aware of what Burr stands for, it's buy, rehab, rent, and then refinance. So basically, as an investor, they try to buy a property at a discounted price or a property that needs work. So they're not buying it at the what they call the after rehab value, right? You know, like a turnkey price in a specific neighborhood, a property that's been remodeled. You know, what's it going to sell for in the open market? They're going to buy something that's discounted, that needs work. They're going to come in. They're going to rehab it. They're going to fix it up, make it nice, make it modern, make it modern. Take people, make it so that whatever people are looking for now is what they see in it. And if they're going to buy and hold it for a long time, they're going to ultimately rent it out after they rehab it. And once it's rented, they're going to look to refinance, get their investment back out from the rehab. And hopefully, if they did it right, their goal is to cash flow to a certain extent, and so that's what this meetup was about. Is like there is still opportunities for that if you are an investor, whether it's your first property or second or third, fourth or fifth. You have to maybe be a little bit more creative or think outside the box. Like a lot of things that I see going on here in Southern California is adding ADUs. If there's a detached garage, or maybe you're just adding an extra ADU because you have a good sized lot. It might not cash flow as a single family residence, but if you add an ADU, it's gonna up the cash flow of that property, and now you might be in a better position to be able to rent it and cash flow on the property. So
that's
what
a strategy right there.
Yeah.
Is getting that done, man. The investors that I've seen, it's interesting because I'm, here the investors that I've been working with or have worked with in the past don't always tend to be the fix and flip investors.
Yeah.
It's the I want to buy and hold. I want to fix this up and make sure that I not only try to get this thing to cash flow, but also take advantage of that long-term appreciation.
Yeah. Yeah. And especially in a market like California where the properties are going to go up over time, or there's bigger jumps in equity, or there's just more margins to work with in terms of buying a property that's discounted and having enough room to rehab it and be able to refinance and get your money back out, or at least a portion of it. But definitely seen a lot of investors taking advantage of that ADU. That meetup that I went to, it just happened to be at a property that the investor was in the process of rehabbing, and it was a single family residence in Claremont that had a detached garage. And by the time they were going to be finished with it, it was going to be a 3-unit property. So it was going to be, the front house was pretty big. It was going to be divided into 2 units. They're going to put a wall right in the middle. It's going to be a 3-bedroom in the front and then a 1-bedroom, 1-bath on the back portion of the house. And they were going to convert the detached garage into an ADU, a 2-bedroom, 2-bathroom ADU. So it started as a single family residence, and it was going to be a 3-unit property by the time they were done. So making it to be able to cash flow around $1,500, $2,000. So obviously it's going to take a little bit more work. Also, the time for the project to be finished is going to be a little bit longer, because it's going to be more of a 6 to 9 month project, as opposed to if you're only fixing that first unit. It's not going to be as long, especially if you don't need to pull permits. But if you're doing an ADU, additions, anything like that, you usually got to go through the permitting process, and that's going to add a couple months just in that permitting process, getting an architect, getting your plans approved from the city or the county, depending on where you're at. But that's what it takes to be able to cash flow a property, at least around here in Southern California, as an investor. So it is possible. The savvy investors are figuring out a way to do it. And, you're able to do it with surprisingly, I mean, I wouldn't call it a low amount of cash, but as an investor, you can do a fix and flip, or, you can get a loan to rehab a property with 10 to 15% down, which typically, if you're buying an investment property, if you're doing conventional, it's going to be 20% or more, you know. But if you get a fix and flip loan, you can do it with 10 or 15% down. A lot of times what determines what your down payment is going to be is your experience as an investor, like how many properties you have under your belt. If you have 3 or more, that typically tends to be what the lenders are looking, those types of lenders are looking for. You have at least 3 under your belt. And also the margin on that particular property. The bigger the equity gap, the more willing they are to lend on it. They're not really concerned about what you make monthly in terms of income at your job or as a self-employed person. They're more interested in the deal and how much experience you have with other transactions. And based on that, they'll lend you 90 to 80, 85 to 90% of the purchase price, and then give you most of the time 100% of the rehab. So, you know, if you're buying $1 million property and you have to put 15% down, that's $150,000 down payment. But if you need $150,000 to fix it, they're going to turn right back around and lend you that $150 to fix it. So basically lending you your money right back. And then once the project is done, you can refinance out of it and hopefully either rent the property or they're going to list it and sell the property and, you know, get their money back out. So it's
are those additional funds, do they do it as a second mortgage? How do they structure that?
It's all one mortgage, but they give it to you in segments. So they make you give them a very detailed list of what you're going to do to the property, what the costs are for those specific repairs, and then they give you portions up front. So if you need $100,000 to fix the house, part of that is the kitchen, the floor, maybe knocking down some walls. You let them know, okay, I'm going to do the floor first, and I need $15,000 to redo the whole floor. You close, they'll give you that $15,000 to fix the floor. You fix it, you show proof that the repairs have been done, you show proof of the payments that you made to get that floor fixed, and then they disperse the second portion to you now for the kitchen or for the new bathroom or whatever it is until you finish the project. So they won't give you all the rehab money up front, but they will give it to you in segments as you need it. You as the investor will have to provide proof of what you're purchasing and who you're paying out or how much you're paying out to contractors or subcontractors. And at the end of the day, it'll be one loan, right? So technically you're adding to the balance of that existing loan. And then once you're finished with all the rehab, you have your total balance, and then you go and you refinance out of it into a conventional loan, because most of those loans are shorter term loans. You have 12 months, 18 months, 9 months to pay that money back. So ultimately you'll need to refinance to get out of that. So it's it's definitely for experienced investors, or if you're not experienced and you're looking to get into that type of transaction, you should partner up with someone that does have experience, because not only will you get better loan terms, but you'll also be working with someone that's done it before, and make sure that you go about it the right way. Especially when you're talking about, construction. A lot of those costs sometimes end up being maybe a little bit higher than what you thought they were going to be. So working with someone that's experienced will not only get you better terms on the loan, but it'll give you a smoother process throughout the rehab of the property, and get you that experience under your belt, so that at some point you don't have to partner up with anybody to do it. Not only will you have the knowledge learning from somebody else, but you'll also be able to, jump on a loan on your end by yourself if you have the funds to put down for that property. So it's not a common loan that a lot of people are aware exists, but they very much do exist. And there's a lot of those going on right now with investors buying discounted properties off market, refinancing them, and putting them back on the MLS for those retail home buyers that want something with less work up front. So, yeah. So,
and have you gotten the chance to have any of your clients gotten the chance to use the 5% down for the multifamily loan?
Not yet, but that is an amazing program. Because I actually experienced something like that myself because I bought a duplex, a 2-unit property to where I live, and back then conventional had to be 15% down on a duplex, and so you could buy it FHA with 3.5% down, but conventional has better terms. If you have great credit, your mortgage insurance is gonna be a lot lower, and because of that, your payment's gonna be a lot lower. But my only option at the time was FHA. If I would have had a conventional option, my mortgage payment would have been a lot lower because my mortgage insurance with FHA was over $800 a month. So
Wow.
yeah, and the way that FHA works for their mortgage insurance, it's just a standardized amount for everybody, regardless of what your credit score is. But when it comes to conventional, the better your credit score, the lower your mortgage insurance. And you also don't have that upfront mortgage insurance like you do with FHA, where you have that upfront mortgage insurance that you either have to pay out of pocket or do what most people do, which is add it to the balance of the loan, because it's a large chunk. So with conventional, you don't have that upfront mortgage insurance, and if you have great credit, anything above 740, 750, you're going to have a lower mortgage insurance payment, probably around a couple $100, depending on the value of the property. Luckily, I was able to refinance into a conventional loan before rates went up, and so my mortgage insurance payment went from $800 to $95, which is what it is now. And I locked in at a lower interest rate, closer to 3%. So overall, it worked out well, but I might not had to have refinanced if I would have just locked in on a conventional, and I probably would have had a lower rate because when I did the FHA loan, the rates were lower. So I wouldn't have had to spend the money on the refinance to the conventional side, and I would have a lower rate. But ultimately, I got a great deal. I'm happy where we're at. But for those people looking to buy property now, dude, it's a great thing, especially if you're living in Southern California and you don't want to have an $8,000 payment, and you get a 2 or 3 unit property where you can offset that mortgage payment with other tenants living in the property, as long as it makes sense for you or for your spouse if you're married, and you find the right people to share the lot with, to share the space with. It's a great thing to get into home ownership, and then from there piggyback off that into a new home, or keep it as a rental or sell it and have a larger chunk for a down payment for a new property. And there's a lot of ways you can kind of work with it from there. So I'm really happy to see those changes. So have you seen any people asking about that or taking advantage of that?
The asking, yes, because I think it's only been maybe a month that this has been really out in the real estate atmosphere.
Pretty new.
But it's been mainly me letting people know that this is an option, which is exciting for sure.
Yeah.
And so hopefully
5% on a 3-unit property. I mean, I'm guessing most people didn't even know that before it was 15%, because most people are buying a single family home and you can get it with 5%. But for those that were into that little niche market where you're buying a multi-unit to live in, it's a great thing. It's a great thing, especially if you feel like, hey, I don't want to buy a single family house and have a $7,000 mortgage when I pay maybe $3,000 in rent. But if you find a property that your mortgage is $7,000, but you're going to get $3,000 from this rental in the back, that pretty much cuts your mortgage in half and makes it a little bit more affordable and at least a little easier to take the leap. If you are willing to kind of go through the process of being a landlord and finding the right tenants, because obviously if you're going to be sharing space with them, you want to make sure they are the right tenants. And there's a lot of people that would be great tenants that are looking for a property like that. Like they don't want to live necessarily in a big apartment complex and share a lot of common space. They want a little bit more of a quiet home and a little bit more privacy. There's a lot of people that want that. So as someone buying a home for the first time, you can also provide great value to the rental market by providing a nice place for them to live with a little more privacy, where they almost feel like they're living in a normal neighborhood, and they're gonna love it. So it's a great thing on both ends.
Yeah, I've had clients that end up doing either renting out the other duplex or, you know, a studio that's on top of a garage, and they tend to stay there longer
Yeah.
because, like you said, it's private. It feels like you could end up actually in a nice neighborhood, and that you don't have to deal with a bunch of other tenants, and people like that. The stability is nice.
Yeah, I mean, speaking from my own experience, mine and my wife's, it's like we went from living in an apartment to living in a duplex where we rent the back house, and we would not go back. I mean, we love it. Our tenants love it. They've been here for 2 months, 2 years next month.
Wow.
So originally we did it as a furnished rental for travel nurses. And you know, the tenant that lives back there, she is a nurse. Her and her husband live there, but they're from another state, and you know, been here for 2 years, and it's working out great. So, yeah, it's a good option for people looking to get into the real estate game. And now that they have a low down payment option for doing something like that without necessarily having to go the FHA route, if you have good credit, you should definitely look into it. Like, talk to somebody that's an experienced realtor like yourself, or experienced mortgage loan officer that's going to explain how it works and what you need to do to prepare to get ready for that. But yeah, man, it's a great thing. So hopefully a lot more products like that start coming out, especially with Fannie Mae and Freddie Mac, because they're the ones that drive the conventional loan market, which is one of the biggest. That and government loans like FHA are one of the biggest loans that first-time home buyers use to get into a property. So it's going to be great. I feel like that's the biggest hurdle to buying a home for the first time is saving that money up front for the down payment. And I feel like that's why a lot of buyers are holding back, because not only do you need to save the money up front, but you also are going to have a way higher payment that you originally intended to have because of the higher rate right now. So if you can have that lower down payment and cut down on your mortgage payment, find the right property, you can make it happen. So that's a good thing. So we'll see how it goes. So yeah, what about anything else that you've seen in the market lately, or you know, things that are good, things that are bad? Or
Yeah, you know, it's just the only thing that I'm trying to preach to, you know, people that I come into contact with is that real estate's not going anywhere.
yeah,
It's
no.
You want to live somewhere, real estate. You want to have a great investment opportunity, it's real estate. So trying to get out of that fearful, you know, mindset is just what I'm trying to break, because right now I think between the headlines, between the high interest rates, the even realtors that I've spoken with, you know, oh, this market, you know,
Yeah.
even they're not providing the, you know, that enthusiasm or that optimism about the market. That's what we have to break, because it's a great opportunity. You still want to live somewhere. You need to live somewhere. That's what we're here to do, is instill confidence in the market and make sure that people are getting into the right homes.
Yeah, and it's not, you know, we're not saying jump into it
blindly.
with blinders on. Definitely do your research. And I feel like that's probably the biggest thing that new home buyers should do is do your research, get informed. Don't go into it blindly. Talk to professionals, talk to people that have done it before, talk to your friends, your parent, somebody that's done it most recently, and see how they were able to do it. And that's how you can figure out the way for you to do it, because everybody's scenario is a little bit different, right? Everybody's income situation is a little bit different. So figure out what works for you, how to have that make it happen attitude, and make it happen one way or another, in a way that makes sense for you and your family. Not necessarily making bad decisions, but the more you know, the more aware you are of the decision you're making. So as far as these lawsuits, the rates, nothing's permanent. Just like the lowest rates we had 2 years ago weren't permanent, these high rates that we have right now are not going to be permanent. And if you're able to get into a property right now that makes sense, where you can afford the payment, then that payment's only going to get lower as these rates trend down in the hopefully the near future. But you should get into a property where the payment makes sense for you, period. That way you don't have to worry about, oh, when is this rate going to go down so that I'm in a better spot. But when that payment does go down, it's going to be even better for you, because now you're going to be like, I'm glad I got into it while the rates were higher, because now that the rates are lower, everybody's looking to get back into it. Everybody I talk to that's waiting, that wants to buy a home, what are they waiting for? The rates to go down. Yeah. So if you're also waiting for the rates to go down, then just know there's also a lot of people waiting for the rates to go down. So you're going to be facing some competition, and maybe that's okay for you, but doesn't mean that you don't have to be keeping your eye on the market, your finger on the market now, where if you see an opportunity, you can jump on it. The only way you know if it is a good opportunity is by being in the flow, keeping your finger on the pulse, and then you'll see like, oh, this is a good opportunity because everything else I've been seeing was not, and this stands out. And that was something similar that happened to us. So I hope a lot of people kind of take that positive approach and are able to jump in the market if they have the ability to. So
definitely.
Yes, sir. So I think that's pretty good for